Hello, everyone. I'm Miles. When you see a company's stock price, don't rush to ask whether it's expensive or not. Instead, ask a more fundamental question. What kind of future cash flows are implied by this price? Keep in mind, what we receive isn't just dividends, but EPS. This in itself is a reminder that dividends aren't a given. They're a possible outcome after profits are made. Today, we'll use the multi-stage dividend discount model to answer this question, and we'll do it using the truly efficient solve-to-learn approach from corporate finance, ABC Inc. The current earnings per share, EPS0, is $4. The company maintains a long-term payout ratio of 50%, and the expected earnings growth is as follows: 25% in the first year, 20% in the second year, and 15% in the third year. Starting from the fourth year, the company enters a stable phase, and earnings will grow at a perpetual rate of 4%. The required rate of return for investors is 10%. Question: calculate the current intrinsic value of this stock. Step 1, forecast earnings. Calculate the dividends. Given that EPS0 is 4, the payout ratio is 50%, and the discount rate R is 10%. In the first year, earnings grow by 25%, so EPS1 equals 4 times 1.25, which is 5. D1 equals 5 times 50%, which is 2.5. In the second year, earnings grow by 20%, so EPS2 equals 5 times 1.2, which is 6. D2 equals 3. In the third year, earnings grow by 15%, so EPS3 equals 6 times 1.15, which is 6.9. D3 equals 3.45. You'll notice that we're not just memorizing answers, we're actually generating cash flows. Step 2, discount the dividends from the first stage. The discount rate is 10%. PV of D1 equals 2.50 divided by 1.1, which is 2.27. PV of D2 equals 3.00 divided by 1.1 squared, which is 2.48. PV of D3 equals 3.45 divided by 1.1 cubed, which is 2.59. The total present value for the first stage is 2.27 plus 2.48 plus 2.59, which equals 7.34. Step 3, terminal valuation. From year 4, growth stabilizes at 4%. Year 4 EPS is 6.9 times 1.04, totaling 7.176. D4 is 7.176 times 50%, or 3.59. By the infinite series model, total equals D4 divided by R minus G. P3 equals 3.59 divided by 0.10 minus 0.04, which is 59.83. This value at year 3 represents future cash flows. PVP3 equals 59.83 divided by 1.1 cubed, which equals 44.95. Step 4, the intrinsic value of the stock, P0, equals 7.34 plus 44.95, which is 52.29. Now comes the real insight. The intrinsic value of a company's stock isn't about emotional swings, but rather a rational pricing of future growth, distributions, and risk. Once you truly understand this logic, what you learn isn't just how to calculate stock prices, but also how companies grow, how capital is priced, and how time is bought and sold in the financial markets.